Good morning. Welcome to BioBreak's BYOC, Bring Your Own Coffee Panels, a bi-weekly interactive webinar series focused on providing engaging panel conversations on the most relevant topics in life sciences. Today's topic is the path to IPO, preparing for success. My name is Sarah Ashfaq, and I'm a partner in Goodwin Proctor's Life Sciences practice. I'm delighted to be moderating today, and we'll kick it off with a few housekeeping items. We will be recording this webinar, and a playback will be available shortly afterwards for attendees. Everything discussed is considered off the record. If you have questions during the webinar, please use the Q&A function and send them in to us. We will try to address them, although we have a list of questions that we hope to get through, but if we have time, we will definitely try to address audience questions. We'd like to take a moment to thank our sponsors, Witham, a nationally ranked public accounting firm providing advisory, tax, and audit services, and Locust, a global life science transaction firm. I'll now ask our esteemed panelists to introduce themselves. Melissa?
Hi, Melissa Epperly. I'm the CFO of Zentalis. It's great to be here this morning. By way of brief background, I began my career at Morgan Stanley in healthcare investment banking, moved through consulting at Bain, equity research at Goldman Sachs, and enjoyed the ride. But then after that, moved to a hedge fund, Anchorage Capital in New York City, where I started doing operational hands-on roles to improve the operations of companies. And since then, 6 years ago, started my biotech CFO career, first at our firm, then at Cioxis, and most recently a year ago at Zentalis. So very pleased to be here. Look forward to the discussion.
Great. Anup?
Great, thanks. My name is Anup Marda. I'm the CFO of Cabaletta. Thank you for having me on the panel today. I've spent about 17 years at Bristol Myers Squibb in a whole host of roles from R&D, commercial, capital markets, kind of a good broad coverage of the pharmaceutical world before diving into biotech almost 2 years ago and loving every minute of it. Our company, Cabaletta, is all about teamwork. We went public about 9 months after I joined, and it's been a great ride so far and really enjoying it.
Great. Brian?
Sure, thank you. Brian Coleman from Locust. I joined about 2.5 years ago to build a capital markets business on top of a platform that's existed the last 12 years, focused on specifically biotech, working in a capacity of partnering, sell side, buy side, M&A, et cetera. And the natural extension of that business was capital markets. By way of background, I spent 25 years working for various investment banks, Lehman, JP Morgan, B of A, and ran global equity sales at Jefferies for 10 years before joining Locust to help build out the capital markets effort.
Great. And last but not least, Chris?
Thanks. Good morning. So my name is Chris Gartin. I'm a managing director here in Citigroup's healthcare investment banking practice. I cover life sciences fairly broadly, so I spent about 50% of my time working with large cap pharmaceutical companies. But the other 50% I spend with emerging growth biotech, working both on capital raising on the public and private side, but then also on financial advisory assignments. So very, very pleased to be joining this morning and looking forward to the discussion.
Great, thanks everyone. As you've heard, we have 2 bankers, 2 CFOs, and 1 lawyer, which will give you a diverse range of perspectives from some of the key players in the IPO process. So let's dive right in with our first question. It's been an interesting and very busy year for IPOs and financings. What are the trends you're seeing right now?
So if helpful, Sarah, I can kick it off. So as a CFO of Zentalis, one of the major trends that we've seen, of course, is changing how we can work in the COVID-19 backdrop. Zentalis, by way of background, is an oncology small molecule focused company that was in stealth mode until December last year. I joined them last September to prepare them to go public. And as it turns out, with hindsight, we were the first biotech to go public during the COVID-19 pandemic after the pandemic had been declared when we started our roadshow in March and priced our IPO in early April. But the road to an IPO and a successful IPO, as the topic of the panel, was somewhat different prior to this pandemic experience, where our roadshow had to be fully virtual. So we worked with our underwriters, our investment bankers, and designed a fully virtual 4-day roadshow. And I think one of the major trends that we're seeing is we can, of course, carry on working happily, very successfully in this virtual environment, even as we're doing with this panel. Investors are very engaged and incredibly active, as have the capital markets been. So this new virtual world is something that we're finding a way to navigate successfully.
I would say one of the trends that we've seen, two in particular, one is the affinity towards a crossover round before going public. And the other one is the SPAC space, which I think Chris is going to speak to. But as it relates to the crossover world, if we went back 12 to 24 months ago, crossovers weren't necessarily at the top of the list in terms of things that companies engaged on. But there's a material step-up function in valuation as a result of going to market with a crossover ahead of an IPO. And we led one for C4 Therapeutics in early April, and we closed it by mid-June. So the time frames of crossovers in the market have shrunk materially, and they've sort of accelerated the process of then going public. We were able to get it done and turn things around in sort of from end to end in a 6 to 8 week time frame. And on other crossovers we've worked on historically, it's taken more like 12 plus months. So I think it's a trend that's definitely benefiting companies right now.
So maybe I'll pick up on where Brian left off on the SPAC topic. It's pretty difficult to be talking to management teams or boards in biotech without mentioning SPACs these days. I think just you could probably have a whole panel on SPACs versus traditional IPOs, but just to keep it at a high level, a SPAC is a special acquisition vehicle or a blank check company that you're raising with the sole purpose of finding a private company to take public. Quarterly SPAC issuances across all sectors historically have been around $3 billion. Last quarter, it was $27 billion. And we've also seen that moving into the biotech sphere. And as with most things, biotech's kind of made it its own animal. So in a traditional SPAC, a SPAC sponsor will get compensated either via the promote or via warrants. In biotech, I think what we've seen is a lot of the SPAC sponsors have actually done away with the warrants, making the SPAC option less dilutive. And the reason they've done that is they view the SPAC product as a way to get the allocation that they're unable to get either via a traditional crossover or via the IPO process. And so you've seen not only the large funds like a Deerfield or Brent Saunders just raised a $400 million SPAC earlier today, but you've also seen the crossover funds like EcoR1 and RA and Boxer, RTW all have SPACs, but then most recently also VCs. So funds like MPM or Foresight or 5AM also getting into the SPAC product. And so it begs the question, why are we seeing this, right? I think, SPACs originally started becoming more popular back in March and April when the market was highly dislocated as a way to align on value away from the public market. And people viewed the SPAC product as an alternative to the traditional IPO market, which was closed at the time. Fast forward to today, I think that people view it as a completely viable and parallel track to the traditional crossover to IPO track. And I would just view it as kind of a combination of the two in one transaction. So it's really at its core an IPO and a merger at the same time, kind of collapsing those two transactions into one. But it is a product that I think that we expect to continue to be utilized quite heavily, and as I said, there are 14 or 15 or more biotech specific SPACs that are out there looking for private companies to take public right now.
I'll maybe add to everyone's comments and maybe state the obvious, but the market is very supportive of biotech IPOs right now. I mean, it's a very favorable trend with the wind behind our backs. I think some of it may be COVID related. Some of it is obviously you still need scientific progression and good science. I think the one thing to keep in mind is that the window, when it closes really quick, and days can matter. So as companies are preparing for IPOs in the future, it's important just to kind of have good timelines and cut every day of the timeline that's possible, because you never know. Last year, the window started to kind of close a little bit more. When the XBI, et cetera, start to get a cold, I think the IPO market gets the flu. So it's kind of important to plan and try to optimize timelines as much as possible, I think, as the market evolves.
The first question that clients tend to ask me when they're thinking about going public is, how long is it going to take? What are your thoughts on timing, and how long does the typical IPO process take? In thinking about this, should companies consider a crossover round as essential to a successful IPO? Should they bake that into their timelines? What are your thoughts on this?
Yeah, I mean, I guess relative to the crossover, I think what we've seen is a material increase. I think in 2015, we did the analysis, there were 56% of companies ultimately did a crossover round, 76% in 19, and it's close to 85% today. And I think they're doing it to really lock in the right types of investors to ensure they're going to have a successful IPO. I think they also have leveraged it to benefit them in the realm of a nice step up. So we're seeing larger step ups into an IPO post crossover. We're seeing better performing IPOs with companies that have had crossovers, and we're seeing larger raises than we've seen historically for companies that ultimately have performed a crossover. I think it's used to be in the range of, call it 70 to 80 million, and now it's more like 100 to 150. So I think there are, and to a comment earlier, obviously we're in a bullish market for biotech right now, and it's a trend that companies are absolutely capitalizing on. But if we go back, to 2015 to today, the trend has clearly moved in the direction of companies leveraging crossovers ahead of an IPO to really set the table for investor carry through with quality investors, kind of core key investors that will be part of that IPO process. So you essentially kick your IPO off with a pretty good foundation for success.
Yeah, I agree with Brian. I think it's really a bedrock for the IPO going forward. And as investors kind of come in at different rounds, including the crossover up to IPO and thereafter, I think step ups and just planning things out so that the scientific progress helps the company evolve and investors make money along the way is an important part of the story as well.
And just to add to both of what Brian and Anup said, we definitely did a crossover before our IPO. However, we were preparing for the IPO while we closed the crossover. So tracks can run in parallel. And so if we think about the importance of the crossover, just as Brian and Anup said, and I like the word bedrock, these are investors that have had the time while you've been a private company to get to know you. So it's very important while you're spending time as a private company, as in the CFO role and the CEO role, and to some extent, of course, while the scientists are driving the science forward, also investors get to know your scientists and your programs so that they get to really know you in depth. Because after the crossover, the path to IPO, which on a fast path, fast track, going as quickly as possible with, the exciting nuts and bolts of getting an audit ready, which usually private companies haven't had to do, but you have to have audited financials to go public, and meeting the other listing requirements and SEC rules that go along with working with bankers, working with lawyers, and preparing the company to go public structurally is the fastest end, I think 6 months, and that's what we were able to achieve. But it's pretty ambitious, and there are thankfully a lot of companies that prepare for a long time, and then so whether it's up to a year or more, but with an eye towards going public. And then the crossover round often can take longer than that, so that's why you can see the paths running in parallel.
Yeah, we worked with a couple companies. Ultimately, in the case of C4, we worked with them during the crossover. We were essentially preparing the business section of the S1. We were essentially helping them kind of coordinate and put together the IPO process for a bake-off to make a decision on the 4 banks that they were going to use in the process. So we've seen companies really sort of engage a dual-track process almost during a crossover to make sure that they get to the public markets as quickly as possible.
Yeah, I think that's absolutely right. I think everything's just been collapsed into a much faster timeline, right? So a year ago, I think the cadence was much more that you finished your crossover, and then within the next 6 to 12 months, people were expecting you to go public. I think in today's environment where boards and management teams are looking at the window and wondering if it's going to be open in 3 to 4 months, they're saying, let's accelerate all this. How quickly can I do a crossover, understanding that that is pivotal and critical to de-risking an IPO? And how quickly can I get on file with the SEC to start that clock on that review process such that I provide the optionality to go public if the window is still there? And so I think the typical cadence now is, we've started ordering up with companies actually before they finish their crossover in many cases, as a way to help accelerate the timeline and shorten the timeline to going public.
Thanks, everyone. That's really helpful, and good information on crossovers and timelines for IPOs. As you've heard, IPOs can be a long and daunting process. I'll ask our 2 CFOs, what are the most critical external advisors and internal functions and roles that you leaned on during the IPO process? In your experience, who has been the best positioned to move the process forward and keep it moving?
So why don't you go first? Go ahead.
Oh, sure, happy to, and feel free to add and however you see fit. So in preparing for this panel, thinking about this important question, there can be anyone that champions something within a company, but the important lesson that I think we've learned is there's an individual who needs responsibility. So using a sports analogy, it's the quarterback that's going to drive the game forward. And in this case, for our IPO, I had the honor of being that quarterback as the CFO. So I came into the company, you assess, and that's what I was hired to do, and you assess the company happily, just like the investors that come into the company. You have time to get to know everyone. And then once you're on the path to go public, you need to move quickly. So you need to assemble your team, both internally and you've got within your organization. Of course, your executive leadership and legal advisors that are internal, but you also do need other external parties, just as Sarah asked. So very importantly, and again, to meet some of the SEC requirements, you need audited financials. So depending on as smaller companies, as you grow, often you're not using one of the big 4, but in general, a big 4 audit stamp does come with the credentials. So you may need to think of and assess changing your financial advisors from an audit perspective if you were using a smaller or boutique. You also have to think about the bankers that are going to take you. So just as Brian and Chris were talking about, you're going to need underwriters. Those are the banks that are going to take you public, and they're underwriting the deal for you. And they've been through this hundreds and hundreds of times. So you're going to need a syndicate of bankers that you're going to hire. That is, we could talk about a a lot of fun biotech IPO jargon, but you can have a bake-off, which means you have a discussion with multiple banks to decide who is going to underwrite you and how they think about positioning you, both from a market perspective as well as valuation. And so then you choose your banks, and as Chris mentioned, you org up, which is an organizational meeting, and that's where you have an all hands. So you've got your auditors there, you've got your bankers there, and then also Sarah comes from Goodwin, and Goodwin is one of the legal firms that you also need a lawyer, a team of corporate lawyers that will help you with drafting and writing the S1, which is the legal document you're going to have on file with the SEC. And so your lawyers, your auditors, your bankers, and your management team are some of the key players that you need to assemble. And when you're ready to go public with that organizational meeting, you have everyone around the same, generally, if you can, in the pre-COVID environment, all around the same table. But I've certainly heard of very successful organizational meetings happening during the current virtual environment we're mostly operating in. And so you've got your all hands meeting where everyone assembles and also talks about timelines and roles so that you get those trusted advisors around the table and all aligned on the very intense work schedule you're about to begin. And in fact, already have once you get to that stage.
Yeah, I think all those are great points. And I think just to add a few, it was my first time in my career helping a company go public. And who you're surrounded by is really key. The experts, the advisors, the folks internally. So we were fortunate that we had internally, we had a rock star MD who wrote the business section and worked with our banks. We chose great partners and advisors. Sarah, so we worked with Goodwin, as you probably know, to go public, and great kind of folks there to help us drive the process forward. We worked with Danforth to do the accounting and financial work. We worked with EY. All a great team of folks who we worked with. And, really the key, I think, as Melissa mentioned, the quarterback has an interesting role in that, you want to make nobody should feel like they're more important than anybody else on the team. And collaboration amongst all team members is so key. I think the CFO, besides timeline, can make sure that those connections are made between the various people on the team. Sometimes, things happen, right? He said this, she said this, or he didn't tell me this, or what happened. And just kind of getting all that together and working seamlessly is really important. I think the CFO can also really help to drive timelines. And I'll just give one example. The SEC process was mentioned, I think, Chris, by yourself, right? So the process can take time. And I think when you get that comment letter, it's really important to respond as quickly as possible. And if there are any questions, or lack of clarity, the SEC, I think some people may have some anxiety around calling the SEC or whatever it may be. The SEC is very friendly. They are very helpful. If something is unclear, you can actually call and get a clarification and submit the response back. And this can really help to cut timelines as one moves along the process. So, I think a lot of collaboration, everybody feeling very involved in the process, bringing out their best ideas. I mean, I truly feel like I was blessed with the folks around me in the IPO. And it was my first time. So Melissa, I think you've done this a few times now, right? So it's a little bit different.
I've done it, and I started my career at Morgan Stanley. So I've done it in the banker seat and investor seat, but it was my first sitting in the CFO role, quarterbacking this forward. So it was exciting to see it from the different perspective, as well as, the rules change over time. I won't admit how long ago my first IPO as a banker was, but it is great to, benefit from the current both market that's open, as Anup said, as well as the SEC rulings that have helped change the listing requirements, as well as the path to public, with a few rules, including something called testing the waters, where you can meet with investors prior to doing your roadshow. So something that fits squarely between raising your crossover round and going public is a testing the waters series of meetings where you're getting to educate the investors and spend time with them and answer their questions about the science and the long-term forecast and opportunity that your company presents as an investment. So there are different rules that testing the waters. I didn't know, and now we call them TTWs, and now that's regular parlance for everyone that's going public in the biotech world that, a while ago, I didn't know what a TTW was because they didn't exist. And now we TTW before we go public, and that's how we do it. But so there's a lot of jargon because the rules continue to evolve. And so staying smart with the advisors around the table, just as Anup said, will help you know what the rules are, and what you can do to move quickly and successfully through this process.
Great, thank you so much. And as one of the advisors to many companies that go public, 100% agree, having the support of external advisors as well as strong internal teams to drive the process is essential to a successful IPO. So COVID, how can we not talk about it? And Melissa touched upon this earlier, but I want to ask you all, what has changed in the current virtual world we're living in? And when we return to normal, which of these changes do you think is going to stick? Melissa's company, as she mentioned, was the first to go public during the pandemic. And so she was doing it without precedent in this very uncertain world. So I'd love to hear what you think is going to carry over. The shorter roadshows, 4-day virtual roadshows compared to what used to be 7 to 10 business days, is one thing that people are finding is successful and works. But what are your thoughts on this? Maybe we'll start with Chris on this one.
Sure, happy to. So I think you hit the nail on the head, right? So I think one of the things that will likely stick as we move forward is when you're actually live with a deal and actually out there marketing with investors. I do believe that some virtual shortened roadshow will become the norm. And the reason for that is you're taking less market risk. Things, especially in today's environment, things can happen. It only takes a tweet, right, to move the market 5%. And you don't want to be out there marketing a deal if you don't have to. And so shortening that marketing window from 8 days where you're taking actually a weekend risk as well down to 4 days, so you can be launch and price a deal in 1 week. I think people have found that very attractive, and you're really not sacrificing anything in terms of the number of investors that you're talking to or the quality of meetings that you're having. I think investors, because they've had to, have become much more comfortable with the virtual format, and it really has worked quite seamlessly and takes the whole logistics element of out of the equation. I can't tell you, earlier in my career, stressing about how I was going to get a management team from the east side to the west side of Manhattan in 5 minutes to get to their next meeting, right? So that's off the table, and you can really be productive with the time, with the ultimate goal of taking market risk off the table for companies in a shorter amount of time. I do think, however, that face-to-face meetings are important. In particular, when you look at the stage of development of some of these companies that are going public today, there's several preclinical platform type companies. And in those types of cases, a lot of what investors are investing in is the management team. And being able to meet in person with those folks is very important. Obviously, everyone's kind of dealing with the virtual environment because they have to. But my suspicion is once the virus is off the table and we're back to status quo, that for testing the waters in particular and crossover type engagements, that I do think that a face-to-face meeting will likely be required. But when you actually get to firm marketing of a deal, that it will likely continue to be virtual.
Yeah, I mean, I would just second everything that Chris said. I think it can make the management team more efficient. And I think there will be a blend between virtual and face-to-face meetings. My gut would tell me that we'll probably see more sort of preliminary meetings virtually, and then as people start to do greater diligence and suggest or show more interest of face-to-face meeting, there is there's a subset of investors that, you know, are 100% on board with virtual going forward. And then there's people, to Chris's point, especially with earlier stage companies, that have a preference towards seeing and meeting people in person. I also think that the cost of travel and the expenses associated with that, the time away from the office and everything else, at least a number of the company managements that we're working with have a preference towards being able to do calls from their office. They can be highly effective continuing to run their company day to day and taking meetings throughout the course of the day with investors as part of a capital raise. That's at least what we've seen anyway.
I would like to hear from Melissa and Anup, because it's very easy as bankers to say, no, this is great, and you're going to have 12 back-to-back hour calls in a row with no breaks. I mean, it's very helpful. It's great for us. I think from the company perspective, they have a different view, but it'd be great to hear from you guys on how your processes work.
I'll go briefly, and then Anup would love to hear your thoughts, because Anup had the pleasure of going public prior to the need to do this virtually. So he did the good standard tried and true 8-day roadshow with the weekend risk, as Chris mentioned. I definitely echo what Chris and Brian said. It is extraordinary, albeit exhausting, as Chris said, the efficiency of a roadshow that is virtual, because we started, let's see, we did the 4 days. We decided not to take that weekend risk. And so you launch Monday morning, you do meetings. And of course, the deal is launched that morning. So the first day of the roadshow, the morning, you're doing a teach-in with the sales force of the bank. So you're teaching them verbally and practicing the presentation you're about to give 30 to 60 times on a roadshow. You are then moving from that big group meeting to all of the sales forces to then an individual investor by investor, which often, exactly as Chris was joking, you're not only worrying about how you're getting from the Upper East Side to the Upper West Side in Manhattan, you're worrying about how you're going to get from Boston to Chicago, from Chicago to California, from LA to San Francisco. Roadshows used to even start in Europe. Sometimes they do, sometimes they don't. Sometimes they could include an aspect of the trip to Asia. We were able to do, and now in this virtual world, you can do a virtual roadshow where you're starting in Baltimore, you're ending in on Hong Kong, and then you're starting the next morning in London and Stockholm. So you can actually do all of those by telephone. Now, it is quite tiring, and the bankers are very efficient. So you start a day thinking you're going to have 12 meetings. You might have fit 20 in by the end of the day, but the opportunity to fit in so many meetings so efficiently, and even follow up. If somebody wanted follow-up, you can actually fit that in, where previously you really couldn't, because there was such demand on the schedule from a travel and logistics perspective, which was an enormous burden on the banks that are taking you public, as well as the management team that are going from city to city for 2 to 5 meetings, sometimes just one. So it was extraordinary around the world virtual meeting that we found we could fit in a number of accounts around the world very efficiently. So it was a good adventure. I think there definitely will be an aspect of that sticks around going forward.
So I think maybe I'll add to this a little bit with pre-COVID, post-COVID. So I'm not very keen on travel myself personally, all right? So, but having gone through the IPO in a more traditional route, I probably traveled more than I've ever traveled in my life. And I must say, I have very good memories of how the team really bonded during that period of time. So whether you're taking, red eyes back from California to New York, or, all the different things, getting up in the morning, the hustle of going from one place to the other, the feedback from the meeting live, and just all that stuff really helps bond a team together. That being said, in the post-COVID era now, we've done a lot of non-deal roadshows. We've engaged with banks and kind of different ways of attending conferences and going that full day, as Melissa described, which can get really tiring virtually. And the productivity is much higher, right? There's no travel, as she said, and it's just beneficial all around. I think I think in the future, I think the schools and others kind of have this kind of leading indicator. A hybrid will be some sort of a thing here. And I think, maybe introductory calls are on Zoom, and then, second, third calls, deeper calls are in person, or I don't know how it's going to evolve, right? But I think we can really take the best of both somehow and make this whole thing more productive for everybody, so that, and it has to be catered towards obviously the investors, right? I mean, how they do things, et cetera, et cetera. It's kind of good to be flexible, and everybody's going to have their own preference. But the camaraderie of traveling together and doing an IPO in a more traditional route is lifelong. Some of the best memories I have professionally. I love the productivity of being able to sit here and do a panel today. It's fantastic, and going the whole day with investor meetings as well. So, some kind of a mix in the future. I don't know what it's going to look like, but I think it's it'll evolve naturally. So.
Thank you. This is very helpful. We just got a question from the audience while we're talking about roadshows. Does the entire management team typically participate in roadshows, or is it, a CFO, CEO? What have you seen? What works well? Is it company dependent?
So the answer is yes, right? It depends. Each company is different. Some CEOs can speak to the science, some can't. Some CFOs are much more involved with strategic decisions, others are not. And some chief medical officers are very well spoken and want to be on the road. So there is a point where there's too many people, right? If you try to bring 5 people on the road, it's very difficult for investors to focus and for the meeting to be seamless and for the mic to be passed around in a way that's conducive to a good conversation. But I would generally think that it's somewhere in between 2 and 3 spokesmen from the company that are out there on the road, articulating the story in a compelling way. And any more than that, I think, becomes complicated to manage a meeting.
Yeah, I mean, we've seen where CEO, CFO spend the first wave of conversation with investors, and there's usually a follow-up diligence call with the science team to get deeper into the programs themselves. So we've seen kind of a 2-step function in a number of the roadshows that we've put on for the private companies that we're working with.
Great, thank you. IPOs cost a lot of money. They're expensive. It's a long process. How do you budget for this? What is the cost, if you can give some kind of range? And do you have any tips for managing those costs and keeping them in line with budget and expectations? Maybe Anup, and you can kick us off, and then we'll go to Melissa and others.
Yeah, sure. So yes, it is very expensive. And if you're successful in raising the money, it's worth it at the end of the day. But I think, having gone through it for the first time, a couple of suggestions I would make, and just to throw out some numbers as well. I think understanding and benchmarking from prior IPOs with, either your legal counsel or with the banks, it's good to get a range up front, and there are different items, right? There's the legal costs, there's the auditor costs, there's the folks who do the accounting if you don't have an in-house accounting team, which most biotechs at that early stage don't. There's cost of the printers, which maybe is now gone. I'm not sure, but there's cost with where you're going to list. So these things easily add up to, I would say, more than $3 million, and it depends on who you work with as well. So some companies will have lower rates than others. I think the obvious areas to kind of look at are, the legal costs are a large chunk, and how you work with the legal team is something important to kind of establish. And I think, overall, just having an idea up front of what the costs are and asking for benchmarks and then kind of working forward from that point is important.
Yeah, and I'll echo some of what Anup just said. Absolutely. It's important to manage. It's also a path well tread, even with our new environment. The costs are legally disclosed in the SEC documents that people publish. So happily, there's a plethora of information out there so that you can benchmark and manage to those costs. But you think about, there are standard percentage fixed fees that bankers get. There's often precedents of what the lawyers need to do to help you prepare to take the company public and to prepare the documents that you need to file. First, your confidential S1 draft, which is the full disclosure document, which can be 300 plus pages long, detailing the company and the risks of investing in any biotech. So there are standards out there that you can manage to, but then it's also worth, just as an upset, discussing what the budgets are up front and then helping keep people accountable to those so that you're tracking those costs. And generally, this is a very well-oiled machine you're building of assembling a team of folks that have gone through this before around you, even if you are, or the company hasn't. The great thing about biotechs is we're following the science. So there may be scientists and scientific leadership that haven't gone through an IPO, but you can hire advisors who have. And so those trusted advisors that are with you in the trenches to help take your company public, you all can work together to build that budget and then manage to it. And exactly as Anup said, if it's successful, it's money well spent because you've just brought your company to a higher profile of being able to access the public markets, which if it fits for your company, then you're now listed on an exchange, either the NASDAQ or the New York Stock Exchange. That comes with costs too, and but the benefit can very much outweigh the costs if you're then able to successfully navigate that process.
Great, thanks. We're getting some questions from the audience about the company and organization and how the different functions and roles play into the IPO process. So two questions that have come up that I'll ask our panelists to address, in whichever order they prefer. Does the board have a role in the IPO and crossover process? What do they do? Obviously, they approve these transactions and consider them and pricing and the terms, but do they have a role beyond that?
I think they absolutely have a role. I mean, we've had boards involved in investor discussions. We've had boards bring investors to the table to potentially participate in the raise itself. In the crossover that we worked on, we had 2 or 3 board members that were part of the diligence process for the banker bake-off. So our experience is most of the companies that we work with have pretty active boards that are involved in the company to a large degree, and we've had good success working alongside them in the process. But I think there's a lot of benefit they can bring to a fundraising anyway, given their background, their involvement with the company. And likely their connection or their network of individuals that they could bring to the table that could help a process. So we've had good success with it overall.
Maybe just to key off one of the points that Brian made as well is that in many situations, as I think we referenced earlier, these deals are 100% covered, meaning that we know where the demand is prior to going public. And that is, the point of that is to de-risk the transaction such that you can ensure that the transaction is successful. In many cases, a lot of that demand is coming from your existing investors, most of which are going to be on the board, right? So in particular, in the cases where it's a venture-backed company, those venture firms will have board members who we're ultimately looking to provide us as bankers with an indication for how much of the deal they would be willing to take, which ultimately gives us certainty, or the stick, if you will, to negotiate with public investors on price and deal dynamics, right? And so knowing where your existing investors, including your board, live in terms of their willingness to back a public deal is a very important part of the equation. And so it often lies to the CFOs and to the bankers to have offline conversations with the board members to figure out where exactly their appetite is. Because much like any investor, that appetite's going to change based on what's going on in the public market. And so while they may be very bullish and very supportive at the start of a process, I've been in many situations where as the market's pulled back, your insider demand is pulled back as well, right? And so being in constant communication with the board and with the board members is incredibly important to making sure that you have a successful process when you launch a transaction.
Yeah, I think, Chris, those are all great points. I mean, transparency and communication with the board is just critical. And it not only is important during the IPO process and up to that, but thereafter, I mean, it continues to be critical. So a lot of things can happen during an IPO process, and the last thing I think anybody wants to do is to be caught on the wrong foot and not have shared some information or whatever it might be, where folks may have different opinions and lead to a better solution for the company for something. So I think the board is invaluable, and having a great board is a great.
Thanks, everyone. Melissa, we have a question for you specifically from one of our audience members. In preparing for and going into the IPO, how is the finance organization staffed by position? And we also have another question that I think can tie into this a little bit, and I welcome all of our panelists to offer their thoughts. What are the pros and cons to having an internal full-time CFO versus working with an external group such as Danforth Advisors or the like?
Those are great questions. So I'll start with the first and then would love Anup and everyone else's thoughts. So how do you build a finance team in a company for an IPO that's successful? So actually kind of tying in the second part of it, the CFO, logically, is not going to be the first hire of any company, especially in biotech. You need the scientists, you need the lab work, if you're an R&D company, to drive the science forward to a stage that often companies consider going public. Generally, companies will have raised an A round, potentially a B round, and then often the C round is coincident with the crossover round. That can take anywhere from 3 years, maybe as short as 2, but often, in our case, 5 or more. Many companies exist much longer before they go public. And so the companies of the needs of the company internally, in addition to the scientific staff, also grow on the reporting and management side. So from a general and administrative aspect. And so you often bring in the CFO when you're further along, but you've already probably had someone doing either a part-time or full-time accounting job, and depending on how big the company is and how complicated the company is, you could have a team with a controller, with a potentially, and there are some companies that have a chief accounting officer separate from the CFO, or in my case, I'm one and the same. You often have and need to have bookkeepers that are keeping the general ledger, that are reporting, and often companies start with the good old tried and true QuickBooks and then grow into an enterprise solution like an ERP system that is bigger either before or after they go public. That takes a finance team that knows how to handle the complexities of biotech and R&D, reporting and accounting for. And then, of course, the finance team is going to be interacting with the auditors on a frequent basis as you prepare to go public and after you go public. So how you build a finance team for success really has to do with what internal capabilities you've had when you've gotten up to that. So to start answering the second part of the question, if you already have a great controller, and as happily I did, and a VP of finance, you can bring in a CFO, and you may have a team that's well staffed and prepared to take it public. And then you can, and as we have done, later hire someone who's focused on SEC reporting. If you don't have those capabilities, or you prefer not to spend the company's resources for that, you can also either complement that existing team or hire external folks. And I think Anup has some experience with that, so I will let him answer that. But there's no wrong way to do it. It's just making sure you've got the right skills at the table.
Yeah, thanks, Melissa. So I think it's important who you have around the table, and because the team the company started with more of an interim CFO who was from himself. So that experience, that kind of expertise was things. The money is rarely going to the science.
Apologies for interrupting. You're breaking up.
I'm sorry. Is that any better?
Yes, that's actually much better. Thank you.
Okay, great. Sorry. So, we started with that structure, and we evolved into, I joined the company in early 19 and continue to work with Dan Forth. I think the flexibility in the model is something which is very attractive at that point of time. And then, after we went public, we had been looking for a controller, and we found a great controller. So I think, Melissa, your point on having a very good controller is critical, especially preparing to go public and thereafter. It's very, very important. And everybody has different skill sets, right? So some CFOs may have more of an accounting background, some have more of an analytical background, some have more of a banking background. So hiring people on the team and working with external partners, which are very complementary, I think is really, really important, so that the team itself is very successful. And I also think that as much money as can be put into the science is really key. And that's something which we try to focus on as well. So having a flexible model within the finance organization, having experts, having kind of contingency plans and whatnot is really key in my mind.
Thank you. So we have a number of questions from the audience that are looking for the panelists' predictions as to the future. So with your crystal balls, what do you think about this bull market we're in? How long do you think it's going to last? When and how will it normalize? Also, piggybacking on this, what do you think about the SPAC market and the boom in SPACs recently? Is this a trend that we expect will continue? Do you think the healthcare focus on this is the segmentation too optimistic? Would love to hear your thoughts on this. And one additional question, also related to broader market and trends maybe. Are there specific therapy areas or product stages that are more or less attractive to investors right now in the public markets? Has that changed from the past? Love thoughts on that before we wrap it up with one final question.
So maybe I can start. A lot of questions there, so I'll try to address as many as I can.
Sorry.
So, no problem. Crystal ball. So look, I think that people have been shocked at how productive and supportive the market's been this year for biotech. Do we expect that to continue at this pace? I don't know, right? And I think that's why you're seeing so many companies go as quickly as possible to see if they can access this market while it remains open. If March and April were any indication, the market can completely shut down, right? We've been in a kind of a 10-year bull market generally. Biotech's had its pullbacks, but this year in particular has been historic. And so, I think that people are, the overall arching trend or view that companies and boards are taking is to be prepared and to have optionality, right? And so I think to your point about the SPAC product, I think people are very much parallel tracking conversations now, right? As a year ago or 2 years ago was very much, let me focus on my crossover. 6 months later, I'll focus on my IPO, and then I'll be a public company. Now, in many cases, the investors that you're talking to have both a crossover fund and a SPAC vehicle. And so they're looking at you as an investment through both lenses. And so as a company and as advisors to those companies, our advice is to continue to create as much optionality as possible in markets like the one we're in today that are extremely volatile and can turn on a dime. And so, it certainly creates much more work on the part of the company to try to be parallel tracking all of these things at the same time. I think that should be said. But ultimately, because things can pull back so quickly, having multiple options available to fund the company is ultimately what is going to put the company in the best position to continue to fund the science, as Melissa and Anup can attest to.
I would add to what Chris said, and just the market we're in is obviously quite robust. The inflows into healthcare, generally speaking, have been significant in the last 12 months, whether that's a cycle out of other spaces into healthcare or if it's here to stay. That'll be determined in the future. And then I think the whole capital structure for both private and public healthcare deals has changed pretty materially. There's a lot of options. Obviously, venture cap has always been the cornerstone, but we deal with a lot of family offices that have a pretty large footprint that are operating much like a VC themselves. And you also have hedge funds and mutual funds that have raised and allocated dollars specifically towards privates. A lot of them are focused on crossovers because what they're seeing is the ability to really capture some alpha between a crossover round and a public offering in a very short and condensed time frame. So the whole landscape has changed a fair amount. I would like to think it'll be here for an extended period of time, but with the election and a whole host of other things as the backdrop, I think that's, to Chris's point, why you're seeing a lot of companies try and get public as quickly as possible. But there is money there. There's plenty of capital waiting to be allocated, and we'll see how that transitions into the new year.
Yeah, maybe I'll add a little bit to Chris and Brian's comments, which I agree with totally. I think timing the market is very hard. It's important, as Chris said, to be in a position to be able to raise money. And there's a lot of work, as we all just discussed, to get to that point. And then hopefully, planning for success. So hopefully in the future, the company does well, the science progresses, and you end up raising a lot of money going forward, because there's certainly in this industry, as we all know, the need to raise a lot of money. Sometimes you may not get a great price. Sometimes you may get a better price. You may dilute yourself a little bit more, but holistically speaking, I think, focusing on the science, the data is really, in my mind, something of key importance, and having that focus. And as far as what's kind of hot right now, I mean, obviously, the COVID names are hot right now, right? So if I think BTIG did an analysis that if you take the XBI and dissect it, and you take out the 20 or so names that are COVID, that area of the market has done well. So I think things will keep changing, but focusing internally on the science, the data, being positioned well and ready to go is what we can plan for. That's in our control.
The only other thing I would add that I forgot to mention is we're also seeing pretty significant interest globally. We see a fair amount of interest from Asia in the deals that we bring to market, and the same out of Europe. And as it relates to Asia specifically, we've seen significant interest in their ability to get involved in U.S. deals, and they've also been creative with the thought process of potentially doing a joint venture for rights in China, as an example. So a lot of different ways to bring capital to the table. but it seems to be more creative and more robust than I've seen it in years past.
Great, thank you, Brian. So we have run out of time. I'd like to thank the audience members for sending in so many great questions. We tried to get to as many of them as possible, and we hope we were able to address them. I'd also like to take a moment to thank our panelists, Chris, Anup, Melissa, and Brian, for taking the time this morning to offer their experiences and perspectives, and we hope that this was helpful to everyone. So on behalf of the panel, thanks for joining us this morning. Bye, everyone.
Thank you, Sarah.